All right, today we're going to tear down a really fascinating story. It's a tale of a company's total transformation, and it's all hidden inside a single earnings report. The company is now called Solana Company, and their report has some numbers that just seem to defy logic. But once you get what they're doing, you'll see it reveals a massive, high-stakes bet on the future of crypto.
Okay, so let's just dive right in with the numbers that, at first glance, make absolutely no sense. I mean, the company's Q4 2025 report throws a massive curveball right at you.
So check this out. On one side of the ledger, they report a net profit of over $325 million. Fantastic, right? But then, on the other side, for that same exact quarter, they post an operating loss of more than $200 million. So, how? How can a company be making a huge profit and a huge loss at the exact same time?
Yeah, that's the central puzzle of this whole report. And in this explainer, we're going to solve it together. Because the answer uncovers the company's entire wild new strategy.
So here's the key. That giant profit, it didn't come from selling a single product. It came from a really complex accounting rule. You could call it a paper profit, and it has everything to do with these weird financial instruments, not their day-to-day business.
It all comes down to this super wonky term called a derivative liability. Now, in simple terms, just think of it as a contract whose value can swing like crazy. For Solana Company, this is all about stock warrants they issued as part of a big financing deal.
So here's the play-by-play. The value of those warrants actually fell during the quarter. And because of how accounting rules work, which can be really weird, that drop in their liability gets recorded as a massive gain for the company. In this case, it was a gain of over $500 million. But, and this is the important part, it's just on paper. It's not cash in the bank, and that's the sole reason for that huge net income number.
But that operating loss? Oh, that was very, very real. It came from the value of their main asset going down. See, the price of the crypto asset Solana, or SOL, it fell during the quarter, and that created a paper loss of almost $180 million. And this is what starts to give us a hint about what the company's real strategy is.
So now that we've cleared up that accounting weirdness, we can finally see what this company is actually trying to do. They've completely reinvented themselves. They are now laser-focused on one single mission: accumulate as much SOL as possible.
You know, this company used to be called Helius Medical Technologies. They've totally transformed. They're not a medtech firm anymore. Their new identity is what they call a digital asset treasury, or a DAT, and their new mission is simple: get more SOL.
And you don't even have to take my word for it. Just listen to this. On their earnings call, one of the directors just laid it out plain as day. They said their main goal, their key metric for success, is growing the amount of SOL per share for their investors. Forget all those traditional metrics.
And this is the number they are so proud of. Forget earnings per share. This company wants you, the investor, to focus on SOL per share, a 14% increase in just 6 months. It shows that every single thing they do now is designed to make this one number go up. So how are they doing it? How are they growing this key number? Well, their playbook isn't just buy and hold. No, it's this really active two-part strategy that's designed to maximize their SOL accumulation no matter what the market is doing.
First up, and this is pretty clever, they actively manage their own stock to get more SOL. They're basically treating their own equity like a tool, a currency to be exchanged for the one asset they actually want.
It's a classic buy low, sell high idea, but they're applying it to their own company stock. When their stock is trading high, they sell new shares to the public to raise cash. They've raised over $29 million this way. Then they use that cash to buy SOL. But when their stock price is low, they do the exact opposite. They sell a little bit of SOL and use that money to buy back their own shares. The goal of both moves is to be accretive, which is just a fancy way of saying it increases the amount of SOL that each and every share represents.
Okay, so that's part one of the playbook. Part two is all about what they do with the massive pile of SOL they already have. They don't just let it sit there collecting dust. No, they put it to work right on the blockchain to earn even more SOL. It's like a constant stream of new assets.
Now, their primary method for this is staking. That's where they help secure the Solana network, and they earn rewards for doing it. But look at this. They are not just passively participating. They are actively managing this stuff, carefully picking validators, optimizing everything for rewards, and it's working. Their staking yields have consistently beaten the network average, which means they're generating extra SOL day in and day out.
And they're not stopping there.
This isn't just some passive holding strategy. This company's actively building new infrastructure and creating new financial partnerships to squeeze out even more yield and contribute to the very ecosystem they're betting the farm on.
I mean, they're pioneering new financial products. They've got this first-of-its-kind deal with Anchorage Digital and Kamino that lets them borrow against their staked assets, a move they think can juice their returns by another 1 to 2%. And they're building for the long term, investing in core infrastructure they're calling the Pacific Backbone to better serve the huge and frankly underserved institutional market over in Asia.
So when you put this all together, what's the big takeaway? What you have here is a company making a very bold, very concentrated bet. They have tied their entire future and all of their shareholders' money to the success of one single digital asset.
Now, an all-in strategy like this, well, it comes with a ton of risk, and to their credit, they're pretty upfront about it in their filings. Their success is completely tied to the price of SOL. The asset is incredibly volatile. We saw that in their operating loss. The regulatory world for crypto is still a giant question mark, and because they stake most of their assets, they can't just sell it all in an instant, which creates what's called liquidity risk.
And that leaves us right here with this one massive provocative question. Is Solana Company a pioneer? Are they showing us a radical new model for how public companies are going to manage their money in the digital age? Or are they just taking an unprecedented all-or-nothing gamble with their shareholders' funds? Only time is going to tell.